Now, Dhaval Joshi from BCA will be sharing with us about what many investors may not be seeing. Dhaval explains what he thinks current groupthink is and how to profit from it. Over to you, Dhaval.
Thank you, Tumi, for the introduction, and welcome to this presentation called Where is the Groupthink Wrong and How to Profit from It. So this question that you see in front of you is probably one of the most important questions for any investor, because the groupthink is what is already in the price. So if the groupthink is wrong, then the price is going to move one way or the other and create a great opportunity, a great investment opportunity. And that's really the name of the game. So what I'm going to present is 6 areas where I think the groupthink is currently wrong, and the opportunities that stem from these errors of groupthink. So let's in the interest of time, let's pass straight in, and let's address view number 1. So this is where I think the groupthink is wrong. COVID-19 will be conquered by pharmaceutical interventions, and the truth is that COVID-19 will be conquered by pharmaceutical plus non-pharmaceutical interventions. So what do I mean by this? Pharmaceutical interventions means vaccines. So people are thinking, vaccines are going to solve this problem. If once everyone gets vaccinated, we have conquered COVID. In fact, we're going to need some sort of combination of vaccinations and behavioral changes. Non-pharmaceutical interventions are things like distancing on and off, face masks, etc. And there's basically 2 reasons why we're also going to need non-pharmaceutical interventions in addition to vaccination. And I think the reason number 1 is this concept of mutations. So what we're finding is that this disease, this virus, mutates like crazy. So the idea that we can just let it circulate and deal with infections, hospitalizations and mortality just by vaccinating the population, that's partly correct. But whilst you let the virus circulate, and as you can see, it is circulating in these waves, these classic waves of infection, you are giving a chance, or if you're giving a chance for the virus to mutate. And we've seen many mutations already, the alpha, beta, delta, lambda, mu variants, and we're going to get more and more. And these mutations evolve to give themselves a competitive advantage, to evade vaccines, to infect more people in a different way. So this is going to be with us for some time. That's a very important thing to think about. The other reason that we need non-pharmaceutical interventions is because you have this thing called long COVID. So even if you avoid a serious disease right now, you have these sort of lingering effects that go on, months and months and months, or years and years, and that is going to change some people's behavior. So all in all, what I'm really saying is that we are not going to resolve this with vaccinations in entirety. We are going to have some behavioral changes, and this will affect investment in the sense that there will be no permanent reopening plays. We're just going to see waves where reopening plays perform well, then they underperform, they perform well, and so on. There is no one-off end to this particular pandemic. It's going to continue in these mini waves. That's a very, very important point in the next year, couple of years, etc. So let's move on then and talk about the second area where I think the groupthink is wrong. And this is the idea that the pandemic is the big story, so that if we conquer the pandemic, we have really conquered the big sort of story or the big drag on the economy, the big drag on the markets. The reality is that the pandemic is the catalyst to an even bigger story. And what do I mean by this? What I really mean is that the changes that we have been going through in the last couple of years during the pandemic, the change to remote retail, remote business, the working from home, the more remote interactions, these were already underway. These precede the pandemic. The pandemic has just accelerated them. And what we're going to get as a result of this is a massive productivity boom. So this was going to happen anyway, but it has been accelerated by the pandemic. It's been condensed into a shorter space of time than it would have. And as a result, as you can see from this slide here, we are seeing a productivity boom, as we always do after recessions. But this will be an even more spectacular productivity boom, because the reason we have these sort of productivity booms is that we use existing technology that's, it's already there, we suddenly adopt it, and that is what causes these big surges in productivity. And the really important point here is that the pandemic, unlike any other previous recession, has changed everyone's behavior. Most recessions affect one sector, whether it's finance or manufacturing, technology, etc. This setback, this recession, has affected everyone's behavior, and therefore we are going to get a particularly large impact on productivity, a positive impact on productivity. So this actually brings me neatly onto the next area where I think the groupthink is wrong. That is that the jobs recovery will be rapid, that we're going to be back to full employment very, very quickly. The reality is that jobs recovery will take a long time, particularly, as I just said, because we are going to see a spectacular productivity boom. So what you can see here is that the key here is not to look at the sort of headline unemployment rate, which is the dotted line, because as you can see, that has that surge during pandemic, and it's mostly come down to where it was proportionately. The real issue, though, is finding jobs for those unemployed who are not on temporary layoff, and that's the black line. So what you can see is that after every recession, to get back to full employment, which is the horizontal line at the bottom, it does take a long time. And we've seen a reasonably sharp recovery so far. But if you look at the next slide, you will see that the pace of decline in this sort of permanent unemployment rate is relatively constant in every single recession, as you can see in the circled column at the end. This is the pace of decline in the unemployment rate per year, and it's pretty much the same through all recessions. I don't see it being that different this time round. And as a result, what we're going to see is that full employment is going to be a bit later than the market is predicting, and therefore liftoff of interest rates is later and shallower than the market is expecting. In other words, I would fade the idea that the Fed is going to be raising rates by late 2022, based on this idea that there's a lot of boxes it has to tick. Inflation obviously has to be well behaved. In other words, if it's come down rapidly, then that's one issue that they have to think about. But of course, the jobs market is the key. And are we going to be at full employment as quickly as the market thinks? That's a big question, and it's certainly an area where I think the groupthink could be wrong. So let's move on. Groupthink number 4, where I think the market again is wrong, is this idea. This is quite an interesting one. Shocks unpredictable. So in a way, that is true. Individual shocks are unpredictable. But this is the really important point. The statistical distribution of shocks is highly predictable. And, let's just look at the next slide. So what I'm really saying is, here are the shocks of the 21st century so far. So, what we're saying is, individually, it's very hard to predict any of them. Dot-com bust, GFC, Euro crisis, EM recession, so on, pandemic most recently. But if we think about them as a statistical distribution, they are very predictable. So you say any length of time, let's say a 10-year period or a 5-year period, we know reasonably accurately how many shocks we're going to get in that period. We do not know exactly when they're going to happen. We don't know exactly what's going to cause them. but the statistical distribution is predictable. So we know there's going to be a shock in the next 5 years, and we know almost certainly there will be a shock in the next 10 years. So that's how we should think about playing shocks. The only question we have to ask is will the shock be deflationary or inflationary? Now, my answer is that all of these shocks we've had so far have been net deflationary, because we end up with the bond yield lower than when we started. That will continue because financial markets and the real estate market globally simply cannot tolerate much higher bond yields. So even if we have an inflationary shock at the outset, it will turn into a deflationary shock. And therefore, the really important investment conclusion here is the ultimate low in the T-bond yield is still to come when we get the next shock. The ultimate end of the structural bull market is still to come, because that will coincide with the low in the bond yield. But it will be led by growth sectors, because it will be those that benefit from a low bond yield. And importantly, as you can see on this next slide, the ultimate high in the dollar is yet to come, because each shock, as you can see, takes the dollar to a new high. Because of the capital flows into the dollar, every time you get a shock, you get massive moves into the US stock market, out of other stock markets, and into treasuries. So the ultimate high in the dollar is also still to come. So let's move on to groupthink item 5, and that is the world is entering a commodity super cycle. And the truth is that what is good for metals is bad for energy and vice versa. So really the important point here is, look, you can make a bull case for copper and metals, this idea of decarbonization, end of fossil fuels, etc. But then that is bad for oil. Or you can make a positive case for oil and say that this whole sort of decarbonization story has been overdone. But then that is bad for the metals complex. So it's really hard to see a situation where both copper and oil, or both metals and oil, do well simultaneously, as was the case at the beginning of this century, where you had this sort of combined rally in all the commodity space. So what I'm really saying here, this is very important, is you can be bullish on one element of the commodity space or the other element of the commodity space, but it's really hard to find a story that is bullish for the whole space. So this is really sort of allocating between commodity sectors, not the whole entire commodity space, energy plus metals combined. Very, very important. So let's now move to the final groupthink, which I think is wrong, and that is that cryptocurrencies are a passing fad. The truth is that cryptocurrencies are here to stay because they are going to secure the blockchain. That is really the key point, is that this is not about cryptocurrencies. The underlying technology is the blockchain. If the blockchain succeeds, cryptocurrencies will also succeed. They have to, because they're essential to the implementation or the operation of the blockchain. So let's have a quick look at a quick comparison, I think, between cryptos and gold as a sort of investment opportunity at the moment. I think this is really important at the moment. Let's agree that neither of them are a medium of exchange at the moment, right? Also, both of them are seen as an anti-fiat store of value. In other words, if you want to take a hedge against the fiat monetary system, both of them give you the option. That's what cryptos are often known as the digital gold. So where there is a big difference is, do they have an intrinsic value? So we know that gold does have an intrinsic value. It's not a lot, and I'm going to describe this in a second. But cryptos at the moment don't have an intrinsic value, some people say. But what I'm really want to sort of emphasize is, if the blockchain, or if certain blockchain networks succeed, then the cryptocurrencies that are validating those networks must also succeed. Specifically, I want to talk about Ethereum, because if the Ethereum network becomes the go-to place for things like smart contracts, decentralized finance, etc., then the way that the blockchain will operate is that people who want those services will have to pay in Ethereum, and the people who are validating the blockchain will get paid in Ethereum. And this will sort of, turn this question mark here into a tick. So, really, the last slide that I want to show you is this one here. So what I'm really saying is gold has a very high value, as you can see from this slide here, mostly because of its anti-fiat hedging value. And you can see it very clearly because the dotted line here is the scarcity ratio between gold and silver. And the scarcity ratio is around 15. So that means that gold should be trading at 15 times the price of silver. And from, as you can see in this slide here, for many, many decades or centuries, it did. So the reason that you got this big spike in the gold price twice, in 1931 and in 1971, is because the monetary system broke down first because the gold standard collapsed, then the Bretton Woods system collapsed, and people wanted the anti-fiat hedge, which was gold. What I'm really saying is if you have an intrinsic value to cryptocurrencies, as I've argued just now, then cryptocurrencies will become the de facto anti-fiat asset of choice, and therefore they will displace gold. And I think this gives cryptocurrencies a huge upside in the near term. The flip side of this is that gold is going to lose a lot of this premium, that you see in this slide here. So I think I've run out of my 15 minutes of time. So just to summarize, where is the groupthink wrong? Point number one is that COVID-19 will be conquered not just by pharmaceutical interventions, but it will also need non-pharmaceutical interventions. Groupthink number two, the pandemic is the catalyst to an even bigger story, a big productivity boom and a change to the way we live our lives and do business. Number three, the jobs recovery will take longer than people are currently anticipating, and therefore monetary tightening will occur later than people are anticipating. The statistical distribution of shocks is highly predictable. The individual shocks are not predictable. And in the next shock, we're going to see the ultimate low in bond yields because it will be a net deflationary shock, as have all previous shocks been this century. Number five, in commodity space, what is good for metals is not good for energy and vice versa. So therefore, you can pick within sectors of commodities, but the overall space is not going to be in a super boom. And finally, cryptocurrencies will secure the blockchain. The blockchain is the radical technology we should be thinking about, not cryptocurrencies. If the blockchain succeeds, cryptocurrencies will also succeed, and therefore they are here to stay. And I think there is significant upside to their prices, certainly selected cryptocurrencies like Ethereum. And with that, I will end the presentation. It was a pleasure to present. Hope to see some of you again.
Thank you so much, Dhaval, for that insightful presentation. I'm pretty sure that we could hear about it for a lot longer.